Fine Business Radio with Lindsay Williams.
It's just after 6 o'clock on Thursday, the 19th of February 2015. It's the first day of the Chinese New Year. It's the year of the goat. I'm Lindsay Williams and this is Fine Business Radio on FMR 101.3 FM. Then we go to a very frozen north part of the world, and that's Quebec in Canada. It's minus 29 at the moment. And we speak to Lee Adler, the founder and proprietor and editor of the Wall Street Examiner. He tells us his views on the US stock market and Janet Yellen, the US Federal Reserve. It's fascinating always with Lee. The S&P 500 this week has made all-time record highs. It closed above 2,100 for the first time in its history. The man that has called this market for the last 6 years and for the last 2.5 years, I think, since I've been chatting to him, is an ex-Wall Street man himself. Now he's gone from trading and ripping people off to informing people about Wall Street. He's the proprietor and founder of the Wall Street Examiner. His name is Lee Adler, and he's talking to us from North America. And it's quite cold up there, Lee. Just give us an idea of exactly how cold it is in Canada at the moment, please.
Yeah, I'm up here in Quebec, and the morning lows are around minus 20 to minus 30 Celsius. The last several weeks, it's been delightful.
I'm sure it is. I'm sure you're having a really good time. Practically balmy stuff. Of course, it hasn't been chilly on the stock market at all because, as I said in my introduction, 2,100 was achieved on the S&P. It came back a couple of points yesterday. You've called it. I think you're calling it a little bit higher as well from the notes I've been reading on the Wall Street Examiner.
Yeah, in the short run, it looks a little bit higher here, but I think we're splitting hairs now because we're starting to see some signs of at least a short-term top-building process. You know, every time the market has gotten down to the point where it looked like we're going to break the major trend, I mean, we would come right down to that trend line, and long-term indicators would be right in position for major sell signals, and I'd get all excited and say, oh, my goodness, we're going to start the bear market. I think we've done that 4 or 5 times now, and each time we've gotten to that trend support level, the market has reversed and bounced pretty hard. But this bounce has been kind of anemic. It seems like it's been explosive, but the S&P is extremely thin in the 2,000 range. There's not a lot of stock offered, so it's very easy to go from the bottom of the range to the top of the range. And the top of the range before this was about 2093, I think. And, so we've inched ahead a couple of points from there, but, we've suddenly sort of run out of gas. I haven't looked at the market this morning. I don't even know where it is, but, it just seems to me like, if we have 2 or 3% more of upside, that's probably it. And like I said, I think at this point we're splitting hairs.
Do you think that we're getting close now? Because every time that it tests a downside support and the indicators look as though they're going to call a bear market and it rallies from there, it makes the move to the downside all the more impactful when it eventually does occur.
Yeah, we'll eventually get down there, and I think the fifth time might be the charm, When we do break support, obviously all the technical traders are going to start selling, and we're going to see pretty strong decline at that point. But first things first, they got to get back down to the 2,000 area, and then they have to break that. Then it'll generate a little wave of selling, and then of course they'll rebound again. We're still in this period that I began talking about last July, where we go up and down in this top building process, making minor new highs along the way. And each time we come down, maybe we test the low or make another minor new low. And those periods tend to last anywhere from 8 to 18 months. So, and I don't think we've made the final high yet here. I think, as I said, probably go a little bit higher, and then we come down, then we test the high again this summer. But looking at the time perspective, I do think the next 3 to 4 or 5 months, we're likely to see the final high of this cyclical bull market.
It is a cyclical bull market. We'll be 6 years and 3 months into it, because I think the low was achieved on the S&P on March the 9th 6 years ago. And just wonder how long it can last, because the bear markets never usually last as long as the bull markets do. So it might be just a quick washout. What's your sense when you look at the charts at the moment?
Yeah, the longer they delay the final top, the shorter the bear market will be. If you go back to the 1960s, in the late 60s, I think the first real bear market was 68, 69, if memory serves. I was just a teenager back then, but that first bear market didn't last all that long. Was pretty sharp. If we get a final top here in the first quarter and establish a new low where it's pretty clear that we're making a pattern of lower highs and lower lows, then I think we're probably looking at a period of 18 months or so, with a bottom in 2016-17 if past norms apply. I don't know if past norms apply when you still have central banks intervening and manipulating the market to the degree they are. That's the big caveat here.
Yes, it is.
Of course, we're looking forward to the ECB, what's going to happen with their quantitative easing beginning next month.
Yeah, but the saturation point must come at some stage where the market says, just can't take any more of this money. But while there's an S&P, I suppose you can. While there's a market that's open, you can do whatever you like with it. What do you make of Yellen? I noticed the FOMC minutes were out a couple of nights ago, and they sort of said, well, we want to raise rates. Of course we want to normalise rates, to whatever that means. But we don't really want to do it right now, and certainly not on our watch.
Well, I spent 25 minutes in a tirade yesterday doing a video for RadioFreeWallStreet.fm. That's a site where I post a weekly video for traders.
Yes.
And I just went off on a rant, having spent the better part of the afternoon carefully reading the minutes. It was 18 pages of gobbledygook. But there were some important passages there, and I was just outraged by what I read. If you read that carefully, they're making it up as they go. They're saying, oh, the economy is so weak. It's like a mother who keeps breastfeeding her child until he's 6 years old because she thinks the child is too weak to remove him from breastfeeding. Well, of course, the child is dependent, but who's really dependent? Is it the mother or is it the child? I think the Fed is so dependent on the feeling that they're all powerful and that we can't take the economy off of this, morphine drip or whatever you want to call it. After 6 years of this, it's delusional. It's insane. And, they have to begin normalizing. The problem, a lot of the pundits looked at the minutes, and there was a lot of analysis on when the Fed is going to raise rates. But there was no discussion of how the Fed is going to achieve that. How does the Fed manage to raise interest rates when in the U.S. banking system there's $2.7 trillion of excess cash lying around in the banks? In the old days, they would manage interest rates by keeping reserves tight and adding a little reserves or withdrawing a little reserves to kind of push the interest rate around. Well, now they can't do that because there's simply too much cash in the system. So they're talking about, in the minutes, they're talking about the tools they're going to use, the reverse repo tool, and, they're going to pay interest to the banks on that or increase the interest that they pay on excess reserves. Well, think about this. If you're a bank and the Fed is taking, let's say, several banks, $1 trillion worth of cash that's sitting on the Fed's and the bank's deposit accounts at the Fed, and they move that over to what's called a reverse repo, and they pay 25 basis points on that. So suddenly the banks are going to receive an additional 25 basis points on some hundreds of billions or trillions of dollars in assets that they hold. How is it that paying them an additional income is going to force them to raise interest rates to their customers? That just makes no sense, none whatsoever.
You sound as though that tirade last night is worth having a listen to, because you had a bit of a tirade then for 2 minutes.
Absolutely. And that was just one point. There were so many instances of the Fed's delusional thinking about the economy and its importance of the monetary policy for jobs and talking about what normal unemployment is. And they're just making it up as they go. And it just, when you look at it carefully and you consider the logic, there is no logic there. And you can go and listen to that at RadioFreeWallStreet.fm. It is a subscription service, but it's not expensive. And I will be posting posting it for free in 2 months on the Wall Street Examiner YouTube channel if you want to wait.
Yeah, well, we don't want to wait now because it's in 2 months' time it might be too late. But let's have a look at all the services you've got. You've got Radio Free Wall Street.fm, which is the wrong title because it's not free at all. But we know what you mean. It's free from...
Well, we are exposing the lies and the misinformation that the Wall Street establishment and the Fed and the government agencies all dish out to the public day in and day out through the captured media. So to that extent, it is Radio Free Wall Street.
I understand exactly what it means. It's free in a liberating sense rather than free in a monetary sense. You should go on CNBC, by the way. They'd love you on that one. And what are the other services that we should be really having a look at so that we can find when this top is coming in the S&P? Because when it comes, it's going to be fun.
Well, I cover the Fed and the actions of the major central banks in the Wall Street Examiner Professional Edition. I also do the nightly technical analysis of the market in the Wall Street Examiner Professional Edition. And you can go to wallstreetexaminer.com and get information about that there. And we also post a lot of free articles, both by myself and some other writers who are really excellent in describing what's going on for real in these markets.
And, of course, you can listen to Leah around about once every 6 weeks on this show. But I urge you to go to wallstreetexaminer.com and have a look at the professional edition. I read it. And I can tell you, I'm just waiting with bated breath to get that sell signal from the Wall Street Examiner. Lee, thanks so much for your time this evening. It's Lee Adler from the Wall Street Examiner from a very chilly Quebec, Canada.